Hi, everyone. Thank you so much for joining us today. Today, we're going to give some insight on what happened in the second quarter, which was April 1st to June 30th, 2022, as well as what the investment management team at AssetMark sees moving forward. We're also going to go over headline news, which is inflation and what's going on with recession. There's a lot of talk about that right now, as well as how to navigate volatility in up and down markets. We did see record high inflation, so rising interest rates and recession fears were main headlines here dominating the news. With the exception of commodities, pretty much all major asset classes were lower in the first half. Commodities being your energy, your grains, your silver, your gold. If this does continue, we would rank only behind two Depression-era downturns, which was 1931 and 1937. They did see losses going right around 20%. Within equities, the S&P index, it did have its worst first half since 1970, losing almost 20%. International equities fared a little bit better than the US, despite the war with Ukraine and Russia, as well as China's economic toll from the zero COVID policy. Developed international and emerging markets did end with negative 19.3 and negative 17.5. A strong dollar did have a significant impact, and as well as international emerging markets ended the first half negative 10.9 and 13.5%. Meanwhile, bonds did struggle, and the Bloomberg US Aggregate Bond Index is down more than 10%. This is rare, as typically bonds do act as a ballast or a stabilizer when stocks go down. Relative to global bonds, US government bonds and investment grade bonds did do a little bit better. Bank loans were the best performing given the floating rate coupons that have held up here with rising interest rates. We'll get into that in a few slides here. Inflation from CPI, which is the Consumer Price Index, it did increase 8.6% for the 12 months ending May 2022, which is the largest increase since December 1981, more than 40 years ago. The all items less food and energy index rose 6% over the last 12 months. Energy alone went up 34.6% over last year. This is the largest since September 2005. Food index, it increased 10.1% over the last 12 months. This was all information ending as of May 2022. This is the first increase of 10% or more since 1981. So we're going back and setting records here. Following the May inflation reading, June meeting, the Federal Open Market Committee, FOMC, they did raise the target fund rate 75 basis points, largest since 1994, as well as in their July meeting, which happened last month, July 27th, they did raise another 75 basis points as well. So it's very clear that the Feds do want to increase interest rates. The cost of borrowing money is a lot higher, and they want to control this inflation and knock it down. While the Fed believes it can be successful in the efforts, could it tip the economy into a recession? Are we already there? We're gonna find out soon here. Relative to the GDP, we're starting to revise the growth forecast now. We were putting in the fourth quarter of 2022, it's gone from 2.8 down to 1.7. So we're gonna see that slow growth head into 2023 as well. Three major contributors to inflation as measured by CPI, Consumer Price Index. It's your labor, wages, and supply chain. So there's also commodity prices and shelter, which play into this as well. When we look into these components, it's important to keep in mind the sequence of rising interest rates, which lead to declining growth and then declining inflation. So it's step by step. Wages, as the Fed raises interest rates to slow the economy, this should tighten up the labor market. It's still very early, but we're starting to see signs of loosening labor conditions. And we're starting to see higher jobless claims as well as higher unemployment and a lower average per hour wage. This is the clearest example of the Feds right now, if they're getting their objectives. Weaker unemployment data would suggest a lower inflation contribution from wage growth. Shipping container prices, so cost of shipping goods and containers, this has been going down since March, so it's cheaper to ship now. Experts do say it's still too early for retailers to celebrate, so there's still a big backup of the supply chain. We're starting to catch up, which is nice. So the orders that were placed, we're starting to catch up on there. During most of the past 2 years, cost of transport shipping containers it went up crazily. And basically people have now altered their purchasing behavior to less physical goods and are now switching to more service. So since March, prices have went down 19%, according to 2 shipping container indexes. Where we think bonds are going, so we are starting to see rising interest rates from the feds. What's nice is we're going to start to see more coupons with higher interest rates. These are better bond yields, it's better interest for our fixed income investors. So that's good news. Not so good news if you're refinancing or you're a new homeowner, maybe for kids or grandkids, they're going to see higher interest rates when they go to borrow money. And not all recessions are equal. So markets are currently grappling with the question of whether the recent rise in interest rates will lead to an economic slowdown, which would be a soft landing for a recession, or a full-on economic recession, which is a hard landing. While recessions are unavoidable, not all recessions are created equal. So while many define a recession as 2 consecutive quarters of negative GDP, gross domestic growth, there's also other things to consider. According to the National Bureau of Economic Research, NBER, official arbiter of identifying recession in the US. So there's other criteria which include real income, unemployment rates, industrial production, retail sales, and consumption spending. So since 1947, NBER has identified 12 different recessions here in the US. And they go into 3 categories. One is the asset bubble, which will be similar to what happened with the mortgage crisis in 2008. Geopolitical, which, for example, will be the oil embargo, which happened in 1973 and 74. This was typically short-lived, as well as the COVID recession, where government had to shut down with mandates, close the economy down, and that lasted a couple months. Or it could be cyclical, which is defined as a shift in demand and supply. So equity market drawdown will also vary by the different types of recessions. Cyclical recessions tend to have a milder impact on the equity markets, resulting in an average drawdown of about 19%. So we're right in that window. Notably, equity markets generally recover sharply with an average return of plus 36% following the next 12 months. The most severe cyclical recessions occurred in the 1950s. The Fed's dual mandate in 1977, promoting both maximum employment and price stability, which enabled a greater coordination of fiscal and monetary stimulus. Again, it's important to state that recessions are unavoidable. Even with the odds of recession, which may be increasing here in 2022, a recession is unlikely to be as deep as the financial crisis in 2008. AssetMark believes a potential recession in 2022 may be more mild than the past recessions just because of the cyclical in nature. Bear markets, as rough as bear markets are, good news is the future returns really improve once stocks are down 20%. It's on sale, we can go shopping. In fact, stocks priced, back in 1949 to 2020 have shown an average gain of nearly 90% a year later, 39% 3 years later, and 64% 5 years later. We hope these bear market starts, help some beaten up bulls, but we want to confidently stay on the course and perhaps even add to some equity, when appropriate. As I said, we want to buy on sale. An important factor when there is a down market is also rebalancing. A couple important reasons is one for risk management, as well as improved returns. Asset allocation plan is designed to accomplish 2 things: optimal returns and minimize downside risk. Without rebalancing, many portfolios would drift away from bonds into more stocks over time. So while this could increase long-term investments of your portfolio, it will also add more downside risk. This may, for example, may be a good thing for higher highs and much lower lows. And depending on your timeline and your goals, the greater level of risk may derail your financial plans. So we want to make sure that your risk is appropriate for where you're at. You might be selling high and buying low, which is the ultimate goal. And as we continue here, some key takeaways. There was really no place to hide in the second quarter, adding to the pain of the first quarter. It's been the worst start in the S&P since 1970, over 50 plus years, and worst start for US bonds in history. So right now, all eyes are on the Fed's Federal Open Market Committee. They are raising rates very aggressively. They're trying to combat this inflation. Recessions are part of a normal economic cycle, but as I said, not all of the same. We want to remember our long-term fundamentals, invest over the long term, 5, 10, 15, 20 plus years. And remember to diversify and rebalance. Thank you so much for watching. Have a wonderful day.